So a few housekeeping. So this is webinar style. So you might not see other people might not see you who are participating, but be sure you are not alone. And my name is Tayo Olatimileni. Um, I'll just say a few things before we start. Feel free to ask questions anytime, either by raising up your hand or by putting a text in the chat, your question in the chat. You can ask your question anonymously, or you can ask with your name showing as the person asking the question. And either way, it's all okay. And there are no stupid questions. Every question is valid because your perspective or your situation and mine is different. And then, so your question is valid based on your situation and your context in which you are asking that question. So you are allowed to ask any question as it relates to what the topic of today. Okay, so with keep quiet for a moment, and then once again, good evening, everyone. I'm glad you sharing your evening with me tonight. And as you can see, the topic says winning with money and building wealth for generations. And this is a training we've been doing for quite a while now. We've trained thousands of people online and face to face. We've been to conferences and we've taught this subject. We've helped a lot of people in their journey to financial freedom. Today, you'll be learning a few things. A lot of them might be reminder of things you've been taught before, but a great deal of them will also might be new to you. It's going to be a lot of information I will be giving out today, but I just want us to follow me and then absorb as much as you can absorb. And I will upload the video to YouTube where you can go back and have a listen again to the content of this video. Okay, the first thing I'm going to do is a disclaimer that this training is just for uh, discussion purposes, it's for educational purposes only, and it's not to be construed as investment advice. Our investment can go up and down in value, and then past performances is not a guarantee of future return. And if you want to take any major financial decision, please consult your financial advisor. Uh, so that out of the way, we are expected to give that disclaimer anytime you need to mention money to people so that they will understand the context in which the training is being given. So this is just a coaching session. So quickly about the company is called KWC Global Institute, and we train basically on how you can leap. A leap is for you to jump forward in every area of your life. And we call it leadership empowerment to achieve profitability in every area of our lives, be it your career, your business, your family. But the core of this training is going to be on our finances. And our social media handles are there. I will introduce that much to us as we proceed in the training, where you can get more material. This will be the third training for the year. The first training in the year was giving purpose to your money. If you go to our YouTube channel, you can find it there. Second training in February was winning with money. And this is the third training for the year. And we do this once a month, free coaching. So other training we do are the ones you can see on the screen. Reposition yourself is a career development training, and the master class of building wealth for generation and winning with money. We also do take that once in every 2 months is when that occur. Okay, I would move on from there. Enough of introductions. Okay, so the purpose and what we're trying to do is to help individuals, families, hardworking individuals to be able to achieve financial independence, not just for themselves only, but also for people who are coming behind them. We want as many people as possible to understand that to build wealth, it takes discipline, but it's not an impossible task. Okay, it's not an impossible task. It depends on you having understanding of a few things and applying that understanding for you to be able to not just build wealth for yourself, but pass it on to the next generation and also educate them so that they know enough to be able to sustain whatever you have given to them. And like I said, motivation is that I didn't know a lot when I first came into this country. And when I got to know a lot of things through trial, you just try, you make mistake here and there, but I've been able to understand what the Western economy is all about and how you can be profitable and be prosperous in the Western economy. What runs the economy here is totally different from the rest of the world, except it's also a Western economy that runs on credit. Unless you understand that, it might be difficult for us to be successful. But a good understanding of how the credit economy works would go a long way to help us. And about myself, I wouldn't say so much, but I would say I'm an investor. Uh, I still have a day job, so I tell people I'm not in Bahamas. I'm not training you from a yacht. I'm just that guy next door. There's a book called The Millionaire Next Door. They're just ordinary people who have been able to build wealth over a period of time. So what I'm trying to say is that you can relate to me as somebody that I'm not that person very far off from us. I'm an immigrant. I've been in the country for about 1.5 decade thereabout, and then I have a day job. I have a 9 to 5, and then I pay taxes just like everyone else is pay taxes. And but I will show us a few things I've learned along the line. And about my experience in investing, I started trading 2006. It's been a while. They've been running to 2 decades next year that I started trading, but I've been doing trading and investing, and that is what I'll be showing to us today. I am an investor and not a trader. I switched from trading in 2012 to proper investing, and then I'll be showing you a few results that I've been able to achieve over that period. Some people will say, why do you, especially when you're a Christian, people will say, why do you invest? God provides for the birds of the air anyway. Why are you worried? Is it out of fear? Is it this? Only God knows tomorrow, and all of those things people would say. But what I would say is this: that God has given us a responsibility, okay, for us to champion, and whatever is given to us, for us to make sure that it doesn't finish in our hands. God wants us to multiply whatever He has given to us. Okay, even though He's the provider and He secures tomorrow, and then riches can fly away at any time. But He said we should go and study the hand. He said, study their ways. In summer, they gather food into their colony, and then underground. And when winter comes, they're able to feast and enjoy all through winter without having to come out and look for food. What does that mean to us as an individual? It means we have a summer time of our life until maybe the age 60, age 65, there about, when you are still able to walk. So you are expected to at that point to accumulate uh, store food in your closet, and then when you come to retirement, you are able to eat. Your children are able to eat, and you're able to transfer as much as possible. So there are so much lessons we can learn from what God from the Bible regarding wealth. And these are a few Bible verses here. So it's not all spiritual. So we'll go into the practical things very soon. We have families who have been able to pass on wealth from one generation to the other, even in current time, and then we also can do the same by a few things we'll be looking into today. So why generational wealth? So I believe it is the will of God for us to prosper, and number two is for us to have a comfortable retirement, and number three is for us to take responsibility. God won't do for you what you can do for yourself. And in fact, nobody can do for you will do for you what you can do for you. Government won't do for you what you can do for yourself. And in fact, don't some people are waiting on the government. You probably will wait for a very long time. And they ain't coming. If they're going to come, they will come with give water in teaspoon to people. It won't take you anywhere. So it's also why do you have to do that? It's because what is called leadership. Is that someone said that if you are from a poor background, that ends at 30. Once you are 30, you can't say I came from a poor background anymore. You are now the background. You now have to be able to provide for the next generation. At 30, your excuses are over. Because if, and in fact, before 30, your excuses are over. You can't blame your background for your situations anymore because you had 3 decades to be able to turn that around. And we need to take responsibility and become good stewards of what God has given to us. And we need to put to work the law of seed time and harvest, which is the law that governs the whole of the universe. This world is being sustained by seed. Okay, when the first mango tree God created, He hasn't created another mango tree since then. It's just the seed from that same uh, tree that was multiplied all over the world. And I can prove that if you take a single seed of corn today and you put in the ground, it will come out with maybe 1 or 2 cobs. If you allow those cobs to dry and you plant all of them, it will give you like maybe 200 or 300 plants or plants of corn trees or corn plants. And if you allow the whole 100 to ripe and then you plant them again, you're probably going to have an hectare or a forest full of corn. And so that's the law of seed time and harvest. So it can work in your favor if you do understand the way it works. Okay, and the next thing that I'm going to talk about there is that you've given the next generation a pedestal to stand upon. So you're giving them a pedestal to stand upon. A lot of people, you might not probably enjoy benefit from that. Somebody, paying it forward for you, but you can pay it forward for other people so that they can also enjoy what you have provided. Okay, so that they can enjoy what you have provided. Okay, let's move on from there. Okay, yeah, we've talked about that. So now, ways to become a millionaire. There are different ways through which you could actually make money, and I've listed a few of them. You probably can win a lottery. Okay, you can inherit something. You can become an executive of a multinational company. You can start a business. So all of these are ways through which, okay, you can become very rich. But what is the probability of you winning a lottery and becoming a millionaire? Okay, millions of people play it, but we can probably count on few fingers how many people actually win it. Okay, then how many of us will inherit gifts that will make us millionaires? So the odds, are stacked against us in all of this place. How many people become an executive of maybe or of Google or of Microsoft or of Johnson and Johnson or of Barclays for you to become a millionaire through that? Yeah, some people, but if you look at it, not millions of people. Now, when talking about business, a lot of people start business and make money, but not also a great number of people, because a lot of businesses fail within the first 5 years, within the first 10 years. A lot of them will fail. But there's something all of us can do regardless of our profession, and this is what I've come to understand, that regardless of your profession, you can become a millionaire. You can retire a millionaire. You can even earn more money in retirement than you are earning when you were on your 9 to 5 job. And I'll be showing us that today. Okay, if you become very good at what you do, become very, very good at what you do, and then you can make your money work for you. So this is something everybody who is on the planet, okay, who has got a job that brings in something for them, will be able to achieve. Okay, becoming good at what you do, then make your money work for you. Okay, so I believe that this one is something that every one of us can achieve. If you look at statistics across the world, but this one is based on United States of America, that 79% of millionaires in America did not inherit anything at all from their parents. That's 97%, and that's a huge number to think that people who are first generation millionaires are 79% of millionaires. And they came from all these career, teachers, accountants. These are the top 5 careers that produce millionaires in America: engineers, accountants, CPAs, teachers, people who are in management, and attorneys. These are people who are not even doctors. Didn't even probably doctor didn't make the top 5, and some other odd profession that you think will make the top 5. they did not. So you can see that it's not so much about how much you earn, it's about how much you can put what you earn to work to make more money for you. Okay, so let's move on into today's coaching. So your income, this is a quote, your income is your greatest wealth building tool. Your income, if you do have a job, is or you do have a business that gives you money, that income is your greatest wealth building tool. But if you give the money away, paying off credit cards all the time, or on a car rental or car loan all the time, or personal loans all the time, then you significantly reduce your ability to build wealth because your raw material is what you are giving away. And so that significantly will reduce your ability to build wealth because that is your wealth, your greatest wealth building tool. And I'll move on to talk about something that is, I think we should take very seriously, and that is the issue of retirement I've been talking about. So, why should we take this seriously? So, do you know the current worth of your pension? So we that's something that I want us to go and find out. Okay, I don't want us to give the answer right now, whether it's a yes or a no, but you need some of us have pensions scattered all over the place. You don't even know how much you have, where it's good for you to be able to bring them all together, probably into one pot, and let the professional manage it for you until you are able to manage it yourself. Okay. Again, do you have an idea of how much you might need at retirement? These are things that we need to have. We shouldn't bury our head in the sand and not know them. I have here a calculator that will help us. I'll put it in the chat, and then we can after the class we can copy it out and just try out putting in what we currently have. It's going to ask you for what you currently have, how much you put in aside, and what target do you want to get to, and that will, for you, let me say to everyone. Okay, and that will be able to give you a kind of rough estimate of what you are targeting. So I said my story at 40, I had just 6,000 in my retirement pot at 40. When it comes to cash, when I turned 40, I had less than 6,000 in my retirement pot. That was when I had the awakening that, Tayo, what are you doing? You're getting close. In a decade, you're going to be 50. Okay. And when you get into 50, you start looking at, and then that was when I started aggressively and I begin to invest. And today, I can tell you that the story has changed. At least I'm far off from where I was a few years ago. I was yeah, a few years ago. So this is a statistics of from the Pension and Lifetime Savings Association. This is a reputable organization in the UK that monitors and gives statistics on pension. If you look at some of the things they've written here, it said 20% are confident that they are saving enough for retirement. Only 20% of people are confident. 80% of us are not confident that we are preparing enough for our retirement. And that is the reason why this is very important. Now, if you are a self-employed person, 70% of 35 to 54-year-old self-employed savers have less than 25,000 of pension savings. It's even worse for people who are self-employed, whether you're a locum doctor, or you are an IT professional who is a contractor, or you are self-employed in one way or the other, or you are a blue collar person who does who are self-employed, who are into handiwork and the rest of it. He said 70% of us of people already getting close to retirement have just 25,000 in their retirement pot. Why? Because there's no discipline. Nobody, people who are in structured employment get their pension deducted before they get their salary anyway. But if you have to do this on your own, which is what I was doing on my own, and I had to put more effort and be more determined about it. Again, why is it a serious business? If you look at these headlines, they are very, very sad headlines, which doesn't bring smile to my to my face anytime I see it. The fact that some people can't turn on their eating because they are pension poor. Okay, people can't have to turn up their freezer in this country because they don't have enough money to for electricity. And some people can't even retire because they don't have enough. He said, this one says, this headline says, I'm 50 and I'm terrified I will never be able to retire. I have worked since I was 15. So there's something fundamentally wrong. And this is the kind of understanding, and this is the reality that we have in our society. And then if you look at the statistics I have here, you see, it's saying that how much do you need to have a comfortable retirement? You need, for a single person, you need 500,000. And I'm going to take us to this Morgan Stanley website, which is also an echo. So these statistics, the original statistics came from Pension and Lifetime Savings Association. That is where the original statistics came from. You see the link somewhere down here. But again, there's an article by Charles Stalin on this particular topic. Let's just quickly have a look, just a summary of what we have on that page. So if I start from here, so for a moderate lifestyle, for a single person is 300, for a couple is 400,000, for comfortable retirement 600 and 700 for couple, and that's what you expected to have in your retirement. And so they got it from the LPSA. It's a very reputable charity that does that. And then you now look at the average pension. This is actually where I'm going. The average pension in the UK is 228,000 for people who are already in their 60s. If you look at that 200,000, if you put that 200,000 against this table, you see that a lot of people are below the moderate lifestyle when it comes to retirement. They are a lot below what what we can call the moderate lifestyle. Okay, talk less of getting to comfortable. And that puts us on the edge. And that is what I want us all to avoid, that even now you're able to, to start preparing a lot better for retirement. And it's never too late. I don't know how old we are, but it's never too late. It's never too late. Like I said, I started getting, serious at 40, and and I've gone a long way within a very short period of time. So I'm going to start, because what I'm trying to do is to give us the background, then we move on. So I'm going to look at the 7 pillars of building wealth for generations, the things that you need to unlock your financial abundance. There are 7 of them, and this is what I've used to represent it. So there are 7 pillars of areas where you need to have an understanding. So I tell people that building wealth is not common sense. A lot of us believe it's common sense, and it's not. And that is why we lose money. And that's why we have horror stories of people who have lost money in the past. I have lost money in the past also, but not, after understanding this, I've not lost any other dime, any other money, because I've come to understand the expectations and and how to do it and how not to do it. So when it comes to financial education, there's a need for us to understand beyond our profession. There are a lot of people who are teachers, who are engineers, who are doctors, who are lawyers, who are professors, but do not understand this financial education. So there's a need. That's the very first pillar. There's a need for financial education. So we need to seek it. Now the internet is there for us to have a lot of information. Although be careful about the one you consume, for us to be able to educate ourselves to have this financial education. And then again, the next thing that you need to secure an income, which I think is what the first thing all of us out of school, you want to get a job. Okay, so you secure an income, but beyond securing an income is actually being able to go beyond the minimum. In this country, the average income is £37,000 per annum, which I think is just the bare minimum, £37,000. We need to understand how we can increase our capacity to earn more. When it comes to wealth building, it's either you spend less or you earn more. Or when you even earn more, you still need to spend less. Spend less than you make, and then make more and still spend less than you make. I think that is a universal principle that that you can't refute. So you have to secure an income. Okay, that's the next pillar, and then increase your capacity to earn more. And I'm going to show us a graph or a personal example very soon. Then you need financial control. Financial control is ability to know how much is coming in and where is that money going to. If you want to understand that very well, this financial control, I did a 2-hour training on it on January. because that was the way we started the year, financial control. If you go to my YouTube channel, which I will show us in a moment, go and listen to how to give purpose to your money. That is financial control. And then building wealth. Now, how do you make use of the money you have to build wealth? Then how do you preserve your wealth? Okay, so that the taxman doesn't get it all from you. So how do you transfer that wealth to the next generation? Then charitable giving. These are the 7 pillars through which you build wealth for generations. And I put down here as the foundation, spiritual mindset and your body care. Okay, it means your health is your wealth. In this journey, or if you listen to the video for January, in this journey, financial control is not about putting you in bondage. It's actually about giving you freedom. Okay, when you understand what is coming and where they are going, you have more freedom. Okay, you're able to budget your fun. You're able to budget your enjoyment. You're able to budget your good memories. You're able to budget your future, your future security. You're able to do it intentionally, and that is a lot of freedom when it comes to financial control. Okay. So I won't go through, I think I've summarized that page. So I have the explanation here, but I probably won't go into full details. The first thing is mindset. Okay, it's not, someone said ignorance is not a demon. You can't cast ignorance out. You have to, you have to get understanding and get light for ignorance to go away. And so mindset is very, very important. Not to have a mindset that it is possible. First of all, just believe it is possible. Some people believe that you can't do without credit card in this country. Some people you can't do without having a car, without having a loan or a PCP or on your car. Some people you can't do this. No, those are mindset which has been programmed for every one of us to have. But you can have a different mindset towards money, because what happens outside, what is done by what the mindset you have in your inside. Then I will just go through that. I won't flog this again. I've explained it in that diagram. These are areas of personal finances we need to understand: budgeting, debt management, investment, insurance, taxes, estate planning. These are also areas which we need to educate ourselves when it comes to personal finance. Okay, pillar number 2. Yeah, I will just go through that. We go a lot. So this is my personal example when it comes to your ability to increase your capacity to earn more. So I started out in the country at £6.50. That was the minimum wage then. I think it's gone to like £12, £11 right now. £6.50 per hour. And then from there, moved to like £7 or £7.50 healthcare. And then from there, moved to a salary of 28,000 as a support analyst. And then from there, I moved on from there, over the years. So what have I done is to re-educate myself, is to retrain myself, is to do, different things that will enhance, my capacity to earn more. So in the same hour, I put in 8 hours here to earn £6 an hour. And again, I'm putting in the same 8 hours here, probably earning more than times 10 or almost times whatever of what I'm earning when I was here per hour. And so you can increase your capacity to be able to earn more when it comes to this country. When it comes to don't just stay anywhere you are. Make it, build a bridge to where you want to be. Okay, so very few will become millionaires working 9 to 5. And then unless you can make your money work for you. I think we've said that before. And make your money work for you 24/7. Money doesn't sleep. It makes the world go, it makes the world go round, and so it can work for you 24/7. Okay, I'll move on. So the next thing under financial control, which I didn't mention, is, which I've mentioned, but I didn't just spell it out, is the fact that financial control involves budgeting. But I don't call it budgeting, I call it giving purpose to your money. Okay, you got to give purpose to your money. And at times it requires a bit of discipline to do, but once you get used to it, then you won't have any problem doing it. I have a spreadsheet that I maintain on a monthly basis. Okay, so it could be that you have a app that you can use. It could be that you want a spreadsheet that you can have a spreadsheet that can share that spreadsheet with us if you want that. let me know in the comments, and I will share with us. And then again, as I go, if you have a question, please put up your hand, ask me a question, pause me. I will pause at any time to answer questions that relate to what we are talking about today, or any question or anything you want to clarify about the training. I will give you the answer as much as I understand it. And if not, I will let you know that I don't have an answer to it right now. Okay, a 50-30-20 rule is common. A 70-20-10 rule is common. A 60, depending on your circumstances. But I think what is important, which I'm going to lay emphasis on, is this aspect of budgeting or giving purpose to your money. A lot of people meet their needs, meet their wants, but do not put anything aside as per paying themselves. So this is what is called paying yourself first. So you pay yourself first means you take care of your tomorrow. And that is what it is. Before you take money to Asda, to Tesco, to Sainsbury, or to wherever we shop from, before you give your landlord money or give your mortgage company money, you need to give yourself money first. So on your expense list, you should be number one. Pay, tire, X amount. If it's a percentage, it's better for it to be a percentage. 5% of my income belongs to me, or 10% of my income belongs to me, and that goes into a place where I can easily reach it, which is my savings account or my investment account. Very, very important. This is just an example of if you earn 3,000 as a family in the UK, this is how much you can distribute that money and be able to, if you're going about 25%, 30% of your income on housing and mortgages, it's a little bit too high. It shouldn't be more than 30%. But I know if you're on a very low income, that could almost go to almost 40% of your income. And that's the reason why we need to strive to move up. And don't forget that this amber part is my emphasis, that always allocate something, okay, for your savings and your investment. For 5,000 household income, it looks like that, the way you can, just a kind of general idea of how you can move that percentages around for you to achieve financial control. Okay, so let's move on. Let's move on. I think I've discussed this while explaining this. So this is just a summary of that. For the sake of time, I will move on very quickly. We still have a lot to go through. And so I'm going to talk about the phases. So it's a journey, and that's why I've said we have 5 phases in this journey. So you can overlap in your journey of building wealth. These are the things you must have in place. So your phase 1 is the first thing you want to do before you go investing is that you want a good understanding of what money is. We've been seeing money since we were 1 year old. We've been handling money since when we were very young, but there's a need for us to have a more holistic understanding of money, the mindset reset, like I put it here. What is asset versus liability? And there are assets that are money, that are income generating assets, and there are assets that just used to hedge against inflation. Like if for instance, if you have gold. If you look at the price of gold in the last 1 year, or in the last 2 years, gold has gone up so much because of the instability in the economy. You could have gold. Gold is an asset class. Okay, commodity is an asset class. You can have gold bars or silver bar and keep it, but it's not an income generating asset. Okay, you use gold, for instance, to hedge against inflation, not to generate income. Whereas something like shares or real estate is an income generating asset. So you need to understand all of that, what a liability is, and then we now need, in that 4th phase, break old habits. Very, very important. You can't carry the old habit into the future for you and expect to get a different result. So of spending more than we earn, or of not paying ourselves first, these are habits that we need to break in the very first phase of foundation of building wealth and becoming debt-free. Normally within 2 to 3 years, if you want to determine that I'm going to stop from today, not borrowing an additional money, I want to start paying off my debt. 24 months, 36 months, you probably might be able to achieve it and become debt free. What I want to picture is how much you'll be free fund in your hands. Let's assume you don't have a car payment, you don't have a credit card payment, you don't have a personal loan payment. How much will that figure be? that will be free fund in your hand to be able to either invest or even to be able to take care of yourself and go on an holiday, okay, how much will that be? If you think about it, then you know the value of you not having any payments to pay at all. So these are foundational things that we need to have in place. Some savings. So before then again, you need to have £1,000 in reserve fund that you have in your account somewhere that takes care of small emergencies. Okay, for instance, maybe you have a flat tire, you need to change your tire, you need £100 or £200 to buy a new tire. You don't have to go into credit card to do that. Or you want to go and service your car, you don't need a credit card to go and do that because you already have something kept aside somewhere, at least 1,000. And that is the preliminary phase of it. Then habit of paying yourself first, opening your first investment account, and then and again, I said it's better done as a family. Okay, and then so I have here a calculator on debt repayment strategy. I'm just going to put the link in the chat. I think I've done a video on it before, but I'm not sure I ever posted that video. I have it somewhere. Maybe I'm going to upload it to my YouTube one of these days, and then you'll be able to. So if you go to that website, there's a calculator there that will help you manage your debt repayment. What it's going to do for you using the snowball method, which is the best way to do this, to go about this, is that it will help you to analyze, and it's free. The first, if you have 10 different types of debts, it's free for you to put in 10 area, maybe credit card one, credit card two, and then personal loan one, car loan, this and that. Apart from our mortgage, okay, apart from your mortgage, you make a list that way, and how much is your minimum payment, and how much spare cash you have to throw to all these debt. If you analyze to you how much you need to pay on a monthly basis and what date you're going to be debt free, and then how much, if you have extra money, it allows you to add in more money or to reduce how much you pay off on a monthly basis. Very good calculator. That really has helped me on my journey to become debt free. Okay, and phase two, once you've dealt with that in the first phase, second phase is that you want to build a contingency fund, which a lot of people call emergency fund, that will take care of you 3 to 6 months worth of expenses in case you are in between jobs, or that for one reason or the other you are not able to make income. You want something somewhere that could take care of you for 3 months. And I tell people, a lot of people are 3 months away from being homeless or from being on the street. Why? Because if it was a lot of people who are in the middle class, if you lose our job today, within 90 days, we might not be able to pay our mortgages anymore. You can assess yourself. I don't know where we are, but you might not be able to pay our mortgages anymore. A lot of people probably will miss their car payment, will default on their credit card, and do a lot of things within 90 days. And that should not be the case. And then there's a need for us to increase and now automate how much we save. Whether you started with 2%, in phase one, when I say open an investment account, it could just be £50, £20 on a monthly basis, is to form an habit. Okay, once you form that habit, it becomes difficult to break. Just like bad habit that is difficult to break, when you form a very good habit, it's also difficult to break. For me, it's difficult for me to break some habit that are formed, and they are good ones. Okay, so also it is difficult to break this habit once you formed it. So when you get to phase two, some people have of the opinion is that, why are you investing when you are owing people? Okay, yeah, it's a valid argument that, okay, I'm still owing somebody, I'm still owing on my car. Let me pay that card off before I invest. But I would say, no matter how little, start doing it. Form the habit. When you see the results, it will ginger you. The result of you building wealth will ginger you to do a lot more. Okay, that's phase two. Find a mentor in your phase two. Increase your savings, start consolidating your investment, start diversifying, because you now have 10% of your income to play with, to invest, and start formulating a strategy through which you can invest. And okay, if you have children, start putting funds aside for your children. And on phase three of your building wealth for generation, what you will start doing at that point is to further diversify. Okay, you increase your portfolio into different sector. Probably you start moving to dividend paying stocks. So I will explain that to us when we get there. Or at that point, you now understand what a good or a bad investment is. Somebody should come to me now to come and explain within 5-10 minutes. I can screen an investment and know whether it's a good investment for me or it's a bad one for me. And that comes with practice, with experience. I'm going to talk about stock investing today also. There are stocks that I will not buy. And if I see a stock within 5 minutes, 5 minutes is too much. Within 3 minutes, I will know whether it's good for me or it's bad for me. I know whether it's something that's going to lose me money or it's going to make me money, and whether I should buy or not buy it. And so you come to understand it as you go. Okay, pay off your family mortgage at the third level, and then start investing up to 20% of your household income, and formulate your investment philosophy. Like I've said, there are things that I will not touch because it's outside of my investing philosophy. And phase four is when you start maybe helping other people. You have multiple streams of income. You start planning to transfer this wealth to the next generation. And phase five is that you've transferred to the next generation and you're mentoring them and you've retired. Your retirement is coming in for you to be able to guide the next generation to continue what you have done. Okay, those are phases through which we can go to. Those phases will overlap, okay, from you trying to have the right mindset, breaking old habits, into starting an investment portfolio and building on from there into transferring, returning and transferring the wealth to the next generation. Okay. Okay. Any questions so far? Any questions so far? Okay. If you do have, please feel free to either raise up your hand or put something in the chat and I'll be happy to answer. Okay, let's look at the cash flow quadrant. Now, the understanding of this would help us. And I bring this into my training all the time because it helps you to understand what the categories of people within the economy. You have the employees. Let me go to the next one. You have the employees. We have the self-employed. We have the business owners. We have the investors. Okay, so you can be in any of these, you can be in multiple quadrant, but the most important aspect which I want to talk about is the I quadrant. No matter where you are within this quadrant, you must be an investor because that is the only place where you can leverage a lot. So if you have a job, okay, you're an employee, you have a job, your time equals to money. You have no leverage. If you are self-employed, your time also equals to money. You can get paid a little bit more, but you own a job. Okay, it's what you own, is what you do is that here you have a job, here you own a job. It means for somebody like me who is self-employed, I have to work to make money. The days I don't work, I don't get paid because I'm self-employed. So also you could be a self-employed person either as a doctor or as an IT person like myself. If you don't work, you don't get paid. In fact, I think employees are better than self-employed because here, whether the master makes money or the masters don't make money, the employee gets paid anyway, okay, in this quadrant. So, but when you are here, and if you are here, if you're a business owner, not a self-employed business owner, but a business owner that has system in place, people work for you, you're able to leverage the time of people, other people's talent and time to build wealth. But when you are here, you are not the one doing the work. It doesn't require your time. Your money equals a lot of more money. Your money is the one working for you and giving back to more money for you. So wherever you are in this quadrant, your money must flow to the I quadrant. If you're an employee, let your money have the mindset of an investor and let your money flow into the I quadrant. You are self-employed, your money flow into the I quadrant. You are a business owner, let your money still flow into the high quadrant. A lot of people who have their companies today, be it Microsoft, Elon Musk, all of them who are multi-billionaires today have investment in other area of the economy and even in other companies. So all of us must be an investor. Okay, that's the moral of that quadrant built by Robert Kiyosaki, was the one who formulated that quadrant. Okay, other people's money, knowledge, wisdom, influence, and money is what leverage is all about. Okay, exploring investment instruments. So what are the things that you can invest in? So I've talked a bit about you managing money. I talked a bit about, now let's look at what are the things you can invest in. These are a lot of things we can invest in, but they be categorized into 6 major asset classes. So you have stocks or equities, you have fixed income, example is bonds, you have cash and cash equivalent. These are your treasury bills, your treasury notes, your certificate of deposits, these or your savings account. These are cash and cash equivalents. And then you have real estate, you have commodities, like I said, precious metal, okay, generally commodities generally. And then you have annuity will be a cash equivalent. And then you have alternative investment like collectibles. Some people collect arts. Some collect watches, wristwatches. Some collect cars, exotic cars, and the rest of it as a form of investment. These are other, and then starting a business was classified under alternative investment. These are the classes through which you can invest. There could be other ones. Today we have other hybrid ones. You have NFT for those who are Gen Zs, crypto, and the rest of it. Some have classified them as another investment class, but these are the ones that I stick with. Okay, and proven over the years. Okay, passive income through. So let's go now. I'm just picking one of. I'm just going to pick equity and real estate. In this, I'll talk a bit of about cash. I'll talk about a few of them, but the main focus is going to be equity, stock, and real estate as a way to build wealth and be able to transfer wealth to the next generation. And then the good thing that I'm going to do it tax free. Some of it tax free. Majority of it, I would say you can do it tax free. Okay, passive income through the stock market. And then I put here is a low entry level. Why do I say that? So these days we have, I don't think I have it on my slide, but these days we have what is called fractional investing. So I'm going to quickly bring up maybe actually that would means that would mean I'm jumping my slide, but let me just quickly show us something. So I'm going to show us this. Let's come around here, and then let's come around here. So what I want to show us is sort by price. So today, if you want to buy Coca-Cola in America, you need 1,300 to buy a single share of Coca-Cola consolidated. That's the American version of Coca-Cola. To buy Netflix, you need $900. To buy Costco, you need $898. Okay, to buy Facebook Meta, you need $587. So just showing you what the popular ones. But you know what? With fractional investing, you can put in just $1 and you can buy any of these just for $1. You can buy $1 of this, $1 of this, $1 of this, and $1 of this, and $1 of this. Okay, so with £10, you can start investing in stock. With £20, you can start investing in stock with as little as that. Microsoft 300, you can with £1, you can MasterCard 500, you can buy with just £1. So that gives you a low entry level, and that's why I love to teach people on how to invest in the stock market. And this is not trading. Trading will lose you money because 70% of people who trade lose money. So let's say trading. Let me Google trading platforms in UK. Trading platform in UK, 70% of retail traders lose money trading CFD because the government has mandated them to put it on their website. 70% with this particular IG is the biggest one in the UK, and 70% of people who do this lose money. Another one, a city index, 70% of people lose money. You can be lucky and be among the 30%. I'm just telling you the probability is stacked against you, okay, when it comes to trading. And that's the reason why I don't, like I said, I've traded before. I traded for like 6 years. I was taught in fact, those days we used to go to IG office in London, Central London. IG will give you free training, maybe once a month or once a week in their office in Central London. And I've been to a few of such classes and with other platforms, in London before and with other trainers. But at the end of the day, I'm looking for more of those CFD platforms that are in the UK, and then they will show you that this one says 80% of people lose money. Okay, so the probability is against you when it comes to trading. So what I teach on is how can you become an investor? How can you become a shareholder? How can you get dividend from Microsoft? Can you get dividend from Coca-Cola? Okay, how can you vote and be part of what is happening in those companies? Okay, how can you be there for the long term? How can your money be secured? Okay, because the first rule of investing is that you must secure your capital. The second rule of investing is to remember the first rule that you must secure your capital. And the third rule of investing is to remember the first rule that you must secure your capital. And so what I'm teaching you will, to a large extent, will secure your capital. Okay, and then let's just move on from there. Becoming a shareholder with responsibility and benefits. And to do this, okay, it's simple, it's not complicated, just follow me. It's been democratized, like I said, it's been made very, very simple because these days, through your phone, you can become an investor. You don't need to go anywhere. So, just giving us a bit of understanding, that's what is called stock exchange. Stock exchange is where you buy and sell equities, like the shares of company. You can buy bonds there, you can buy and sell currencies there, you can do a lot of other things through a stock exchange. Every country in the world have their own stock exchange. The one in London is called London Stock Exchange. There are quite a number of them in America, but the popular ones are the Nasdaq, which is where you have technology stocks, where they are listed. And then you have the New York Stock Exchange, which is the biggest one. So what does it mean? So it means companies go to the market to list their company. They become a public traded company by selling part of their shares. It could be 20% of the company they've sold out to the public, and everybody will buy out of it and they share profit from the company. And then why do I talk so much about the stock market? This is where most of the pension we contribute at work are put in the stock market. There are over 60 trillion of pension fund money across the world in the stock market. Okay, so the US is the largest stock market, representing for 2% of the 106 trillion global stock market, which is 45%. 45 trillion is the US stock exchange. So a lot of the companies I have invested in, I've invested in over 100 companies. A lot of them are US based companies. And then, like I said, with as low as £1, you can enter it. And I think I've talked about this. This is not day trading, this is not cryptocurrency. I have some cryptocurrency, but this I don't train people on cryptocurrency because they are high volatile kind of instrument through which you can lose your money. And for cryptocurrency that I have, I don't trade it. I bought it like years ago and I left it there. And I don't train on it. Okay, time and compound interest. Now let's go into the real matter. So someone said is the eighth wonder of nature. Of nature. I won't talk about how to calculate compound interest, but I'll just show us a few examples using the link above to demonstrate to us the possibility of what is possible for us for us to make when it comes to the stock market. So the stock market has got an historical trend for the last 95, 98 years of what it's been returning. And so based on that, I'll be giving us the example of what is possible for us when we understand investing and we do investing the way it's supposed to be done. Okay, and so what I put on that page, let me go back there, is that if you have a child who is age 0 today, you've just given back to your child, you open with a £1,000 in that account for them, and you invest for them £200 on a monthly basis until they turn 18 at the rate of 10% per year on return on your investment. By the time your child is 18 years old, they will have 126,000 in the investment account. Okay, that will be ups and down, but the average, if the average is 10%, you have about 126,000 in your account. What can you do? What would your 18-year-old do with 126,000? Okay, they will go to school free. Okay, they won't have to have a student loan. They won't have to pay for accommodation while in school. And in fact, they can buy their first house as a student and make their mates pay the rent. Okay, pay rent and pay for the mortgage for that house. And once they are out of school, they can keep the house or sell the house, whatever they want to do with it. But that means that they live in school without a debt on their neck. That's an example of what you can do with that. And then what if you are already an adult, you're already in your 30s, or what can you do with example? Okay, if you are in your 30s, you do £1,300 on a monthly basis. By the time for another 30 years, by the time you are 60, okay, you have over 600,000 in that particular account. And that is more than the average pension pot in the UK. Like I told us at the beginning, average pension pot in the UK is just over 200, about 250,000 is the average pension pot in the UK. And then you need about 500,000 to have a comfortable a comfortable retirement. It means even if you are starting right now, you can still, and you're in your 30s, you can still get it. And if you are even above 30, like I said at 40, and I'm sure I'm going to get well over this by God's grace. Okay, so let's go through that calculator now. Just show us a few of what I just explained now. Just show it to us. So let's even assume you don't have more than £100 for your child. Starting with £100 at 10% per annum. And then you want to do it for the first 18 years of that child's life. And all you have to put in there is 200 on a monthly basis. This is what you're going to have. You're going to have 120,000 because I've reduced this a little bit. So you're going to have 120,000, which is a lot, still a lot of money. If that child doesn't use this money for whatever reason, and they continue until they are, let's just say they continue until they are 35, let's see what that is going to become. 700. They are ready to retire at 35. They've already reached where they can retire at 35, and that is what it is to build wealth for generation. These days, you have to empower our children to become millionaires because the inheritance tax is changing on a daily basis. Okay, I will explain that when I get to the type of accounts you can open. I will explain that. Let's assume you're an adult, you're probably already 35. Let me start with that age, and then you're going to maybe, let's say, for another 30 years, okay, for you to become 65. And as an adult, you should be able to do a lot more on a monthly basis. And then what are you going to get to? You're going to get to about 790,000 when you turn 65. Let's assume you're already 40, you're over 40 like myself. Okay, sorry, I'm going to put here. So this should be this, okay, and for 30 years, okay, it's still going to give the same thing anyway. Okay, but if maybe you're already someone who is above 40, okay, and then you want to retire at 65, it means all you have, maybe 40, you have 25 years left. It means you probably have to do a little bit more and maybe do 400 on a monthly basis, and that will take you to 500, which is still comfortable retirement. And then what is this telling us? The earlier you start, the easier it is. So and the easier it is because the lower the amount you need, and then the higher your target could be. Let's assume you are already 45 and you want to retire in 20 years time. You probably have to do maybe like 600 or 700 on a monthly basis to be able to catch up. I was doing like 1,000 on a monthly basis because I started at 40, started investing at 40. So I had to do over £1,000 on a monthly basis so that I can, catch up with the time I've lost. And so the earlier we start, the better. You can see the person who started at age 0, at 35, they're already okay. So we are starting at age 20, and you do it for 30 years, you probably don't need more than maybe that 200 to be able to get to a very good figure, to get to 400. So that is just, it won't hurt you so much if we start early. So what am I saying is that the earlier we start, the better. So I've used 10% to do that calculation, and now I'm going to show us real-time historical returns of stocks in the market. So I've used 10%. I will tell you the reason why I use 10% in a moment, but let me prefer this website. I'm going to put these two where I'm going to put all these links in there. I put them in the chat for us. You can copy them. Okay, I've got a question there. Someone said, is the fractional investment different from the S&P 500, please? Okay, I will explain that in a moment. Thank you for that question. I'm going to put all this link in the chat. At our spare time, you can play around with them to help you to set target for yourself and then to play and see around. So let me answer the question. So for fractional investment, it's different. So fractional investment apply to all sorts. So the S&P you've mentioned, I went here the other time. So if you look at up here, you see Asia. So S&P 500 is an index. So an index is like a summary of all the stock in a particular exchange, or it could be, it doesn't necessarily have to be an exchange. For instance, S&P 500 is the top 500 most capitalized companies in America. So a summary of all of them is the S&P 500 index, and you can buy it on a fractional level. Okay, if we Google S&P 500 index funds. So you see a few example of them. Vanguard's got them, HS got them. So you see is a few example of them. For instance, this is an example which is sold at $197. But this, when you buy this, you are buying 500 companies. So that's a summary of 500 companies. Now, if you don't have $197 dollars, you can buy 1 pound of it. So they will give you 0.00 something shares of that particular index. Okay. And then you can also do that for individual shares, like all these ones that I've mentioned. You can buy 1 pound of this, 1 pound of this. So fractional shares apply to every one of them. Applies to ETFs, apply to index tracker funds, apply to individual companies. You can buy fractional shares of anything you want to buy these days. All the new platforms, they offer fractional shares, and then you're able to buy them. Okay, I hope that answers that question is answered. So talking about indices, you have FTSE 100 as an index, and that's the top 100 companies in the UK. You have nickel, I think that's, okay, you're welcome, man. That's nickel, that's 225. Then you have Europe, other ones in Europe. And in America, you have S&P 500, you have Dow Jones, those are the 30 manufacturing companies in America, top ones. NASDAQ is the technology and financial companies in America. Russell 2000 is 2000, small companies, I think, in America that form Russell 2000. And so the average of them is what you buy, and then you can now do fractional investing in them. Okay. Okay, so I said I was going to go into, so I want us to put in the chart. So I have a few of them here. I want us to put in the chart. Let's assume I should give you £100 today, even though you've not done any research at all. Which company will you likely invest that £100 into? And so I want us to please see how that company has fared in the last 10 years. So you can put in the chart. So pick any company at all. Let's assume someone has given you £100 today and you don't plan to eat with it or go on holiday with it, or you want to use it to do investing. Which company, without you doing any research, which company would you put that money? Let me put a few companies in the chart. Which company will you put that money? And let's see how you would have fared, or your money will have fared in the last 10 years. Okay, 10 years, that would be March 20, 2015, was one that money was given to you. Okay, I'm waiting for names in the chat. Okay, for me, the most popular company for me is Microsoft. Okay, because I use their product. I use it at work every day. Okay, let's assume I'm going to just put 2,000 in it. So what would that give to us? That will give you, in 10 years, your money will have become 23,400. Someone's putting Apple there. Okay, so that money would have become 23,400 in the last 10 years. Your 2,000 will have become 23,000. And that's an average of 27%, 27.9% on a yearly basis is what Microsoft would have given you. And this is you doing nothing. This is not you gambling. This is not you trading. This is just you put the money and then throw the app away and then open it today, and you're going to make 23,000 in it. So someone's putting Apple. Anyone else? Quite a number of us on this call. I expect more responses. Apple. Okay, let's assume I put that same money into Apple. Apple will have given me 15,900, and that's an average of 23% on a yearly basis. What am I trying to say? It's more than the 10% that I've used to do the calculation, and then you can see how compound interest could work for you, because the value of the stock keeps increasing on the yearly basis. And I will show you an average. There is one, say Coca-Cola. So KO. So there are different Coca-Cola companies. So let's look at the KO, is the International Coca-Cola Company. Let's see what that will give us. Modest 4,000. You would have been able to double your money in 10 years, okay, at a modest return of 7.99%, which is still more than what you will get from a savings account. That's what Coca-Cola will have given you. But let me tell you something that you don't know. Coca-Cola will pay you more dividend than Apple, pay you more dividend than Microsoft. So you will have gained a lot of dividend along the line. Okay, so let's someone say Nike. Yeah, I have Nike in my portfolio. It hasn't done well in the last 2 years, but let's see what Nike will have given us in 10 years. Nike will have given you 4.6%. Yeah, that's a little bit disappointing, but notwithstanding, your capital is preserved. You have 3,000 in your account by now. Any other popular one that you would have bought? I think we all probably all have Netflix. Let's see what Netflix will give us. Uh, let's see what Netflix will give us, which are some of the new companies that will have given a modest 26% return on a yearly basis. Let's see what Mark, someone said Amazon. Amazon is not doing badly. Let's see what Amazon will have given us. Amazon will have given us 19,000, which is 25% return on a yearly basis. So I think those return, they are very decent. Okay, when you have a mix of them, okay, in your portfolio, they are very decent. I think the data here might be a little bit outdated, but I think you get the gist. Okay, so let's go into the overall market. So I've shown you individual. Okay, so I'm showing you this because some people have a wrong bias towards the stock market. They think because all you hear in the news is the bad news about the stock market. But this is where all the billionaires packed their money. Okay, you only hear Elon Musk lost 20 billion in a day. That's the things we hear in the stock market. What you don't hear is what happens. Oh, they won't tell you what has happened in the last 1 year. They tell you what happens in a day. And it's only the bad days that will make the headline. So this is an example of the last 15 years now. 2090 date. So that's about is it about 19? This is 10 years. So that's about 15, the last 15 years. So this is like the last 15 years. So look at S&P 500. Anything that S&P 500 is a measure of what is happening in stock market worldwide. So its performance is a reflection of global economy. Okay, that's what S&P 500 represents. So see anybody telling you that if you want to start investing, and that's what I'm going to tell you, you want to start investing, start with S&P 500 index fund that tracks S&P 500. Just start with it. You don't need to do any research about it. Just buy ETF on S&P 500 because that is the reflection of general market all over the world. Okay, so if you look at S&P 500 in the last 15 years, it has only been negative in 2 years. In the last 15 years. So where do people get this issue that you lose money in the stock market? You lose money when you trade, not when you become an investor. So I'm trying to give us a bit of confidence that at the end of the day, so S&P 500 in the last in the entire history, talking about 1928, in the next 3 years, that will be 100 years. So in the last 97 years of S&P 500, it has returned an average of 11.8%. Okay, that's the annualized return. The mean annual return has been 11.8%. Okay, in the last 15 years, it has returned an average of 15.5% to investors on a yearly basis. So that's what I say. It's a good dog that people have given a very bad name. So we now go to technology. The same thing, the same year, the same year, they both gave negative the same year. So if you look at that, also it has returned an average of 18.7% since 1986 up to now. And that is again another, is it 30 years or another 40 years or so? That's returned an average of 18% average on the last 14 years. And the last 15 years, a 22% per annum on the average is what the technology stocks are, what they've returned to investors. So what am I saying? I'm making a case for long-term investing, and the fact that it is, you don't observe the wind to sow, like I put in here. Either observe the wind will not sow. If you follow CNN, you will never invest. If you look at what your broke friend or somebody is saying on TikTok, you probably will not invest. But if you allow data to speak, then that will give you the confidence to say, okay, investment could be profitable. And I'm giving an example that it could be profitable. Okay, and this is an historical, this is from 1995. This is S&P 500 since 1995 till I think last week or so, because I went to deliver a a presentation somewhere a Sunday or 2 Sundays ago, and so this is more like a week old. So till last week or so, 2 weeks ago, that I would say. So this is the market. So if you look at this over the last so many years, 95 to date, which I think that's about, is it 30 years now or 40 years? So if you look at the major event in the world, dot-com bubble. You remember the millennium bug when that, during 2000, when we came from the 20th century to 21st century, there was a major bust in the markets. That was when the likes of Google were small companies, all of them, the Yahoo were small companies. So all that happened, and there was a drop in the market. And then you remember the 2008 financial crisis, there was a major drop in the market. Then you remember coronavirus, there was a major drop in the market. And you remember 2022, which not far long, inflation got to 11% in the UK, over 11%. So that was a major drop. But you see where the market is today. And now Trump came in, and we're having a bit of trouble with Trump, with tariffs all over the place. So there's a bit of a drop in the market, which is an opportunity for us to buy more anyway. So if you look at the trend over the years, where is the trajectory of the stock market? Is in an upward trajectory. Okay, is in an upward trajectory despite the ups and downs. It doesn't go on a straight line. It goes up and down, up and down. Every down is an opportunity to buy more. Every down is an opportunity to buy more. Every down is an opportunity to buy more. And if you do that, you will be successful. I can almost give a guarantee, but my guarantee will be based on data. Your data is on your side. You can look at data. Data is saying that you can average 10%, which is better than any savings account when you invest in stocks. So uh, with this little point of mine, I hope I have convinced you that stock investment is profitable. Okay. Okay, now, so let's move on. Doing nothing is or procrastinating is riskier than making an informed investment decision. So don't invest based on what people say. Don't invest on what CNN is saying. Invest based on data, invest based on research, invest based on your education. Take informed decision when you're doing investment. And that's better than you not doing anything at all. Okay? Some people say if you can't fly, run. If you can't run, walk. If you can't walk, crawl. By all means, make sure you keep moving. And someone also said that snail and tortoise, they move forward because they put out their head out of their shell. If they remain in their shell, they can't move forward. No matter, even they are they are slow animals, but they still make progress because what? They took action. They put out their head out of their shells. Okay, so that is a word. So let's move on to how to invest in shares and stocks. How do you actually do this? So I'm giving out all of these, a lot of information out for free because I am not interested in, my interest here is not getting anything out of you to come for an advanced training with me, is that you're able to start something on your own and see the power of it, and then you can move on from there. So there are investment platforms that will help you to connect, to start to get started with investing. Okay. There are quite a number of them out there in the UK and across anywhere you are in the world. There will be a platform that you can use to connect to the stock market. Okay. And it used to be that there's a need for you to call somebody to do it for you in the past, but today, through an app on your phone, you can do it. Now, the following thing I want to talk about is specific to the United Kingdom. Okay, that's the type of accounts you can open. It's specific to UK. Other countries have their own, but these are specific to United Kingdom. But the concept generally could be applied anywhere. Okay, in America, the best is the Roth IRA because you don't have to pay tax later in the future. And they have their 401k, which is their pension account like we have in the UK. And then you have their IRA, which is the traditional one. And then they have the Roth IRA, which is the one that where you don't have to pay tax when you retire. They also have similar ones in the UK here. Across in Africa, there might not be any special account that you can open that will be tax-free or that the government has created, but the principle of putting money into stocks, into ETFs, into mutual funds is the same thing all over the world. Okay, it takes patience, it takes time. At the end of the day, you will be a winner. Okay, the first account in the UK that you can open is a junior ISA for our children. Anybody who is under 18 can open a junior ISA. Parents can put in money, grandparents, friends can put in money up to 9,000 in a tax year, and any money that that child generates from it is going to be tax-free. Unless reforms are coming to ISA this March, we're waiting for the statement from the statement from the exchequer, but I believe that it will be applied retrospectively. I believe that, and I believe it's still going to stay tax free. It's been tax free for the last 26 years, and I believe that will continue. Okay, so that could be for their college, like I've said, or for their first house, and it is tax free. No capital gains tax that they will pay. They won't pay anything on it. You can start with as little as, I say, £100. With as little as £50, you can actually start. Okay, and then the next one, which is the one I love the most, and which I don't have because I'm already over 40 before I discovered it, is what is called a lifetime ISA. For me, this is the best of all accounts we have in the UK. So if you are not up to 40 yet, open a lifetime ISA account and put just £1 into it. Okay, that secures but once you cross to 40, you can't open it anymore. But once you open it with £1 in it, once you are over 40, you can keep paying into it until you're okay. Let me give us the clauses in it. Okay, first of all, if you are 18 to 39, go open a lifetime ISA. What are the advantages? Number one, if you are yet to buy your house, this is a savings towards your house. I know people now. I know people who are personal to me, people in our churches that have opened this now, and they'll be buying their house maybe in the next 1 or 2 years. The advantage of this is that government will give you 25% of any amount you put into it. So if you want to contribute 30,000 or 20,000 towards your first house, for every 4,000 you put into it, government will give you 1,000 free. You can put a maximum of 4,000 into it in a tax year. So we have people who are putting 4,000 this year, they've gotten their 1,000, they're going to put 4,000 next year, they have another free 1,000, and probably towards the end of next year, buy their house. They put in 8,000 into savings, they've received 2,000 free, making it 10,000. And apart from that, they receive interest, maybe 4% interest from the platform on which they've invested the money. So this is an account that will give you about 29% interest on your money without you having to do anything. It's the best in the UK so far if you are under 40. Okay, what are the other restrictions on this account? You can buy your first house with it. If you don't buy your first house with it, then it becomes your retirement account. You can't touch it until you are 60, which is when you retire. If you touch it before then government will collect their 25% back. Okay, any money you withdraw, they tax any money you withdraw at 25%. Okay, so that when you're buying your first house with it, you don't pay taxes. It's free. When you leave it in retirement, it's also tax-free. So you can retire tax-free. That's why I love it so much. And then what other clause do we have in it? So the house you can buy with it cannot be more than 450,000 that you can buy with it. Then you will open it for at least 12 months before you buy your first house. So you can't start today, get your 1,000 and buy your house next month. No, you have to keep it for 1 year, and thereafter you can go and buy your house. And then the time is coming to an end. If you can still open it now and if you are still planning to buy your house, you have 4,000 in one account somewhere that you are keeping for your house, just move that 4K into it to your LISA before April 6. By April 6, you've lost that 1,000. From next year, April 6 to next year, April 5 again, is another tax year. You're entitled to another 1,000 or 25% of the amount that you're able to save during that particular tax year. Okay, so the next account is a junior SIP. Okay, so you're allowed to open a retirement account for your child from age 0. They can't touch it until they are 55. Okay, it's a retirement account. You can put in 2,880 into that account on a yearly basis, and the government will top it up for your child with 20%. That's also free. So what government is doing, when you open a SIP account, which is self-investment personal pension, government returns your tax paid back to you. Even for those who are on benefit, you still get 20% from the government. Children get 20% extra from the government. making your 2,880 to become 360. That's what you get as tax relief from the government when you open a SIP account. Okay, a SIP account is not, I think I made a mistake here. You don't pay capital gain tax on it, but your capital gain tax, you don't pay on it. But when you start withdrawing it during retirement, you pay taxes on SIP account when you retire. Just like your workplace pension, you pay tax when you retire with your workplace pension, you're going to pay taxes on it. Same thing with your SIP. Okay. You can't withdraw until you are 55. The age is going to 58 very soon. In the next 2 years or so, in the next 3 years, I think the age is going to 57. So a lot of us who are not close to this age probably won't be able to touch our pension, our SIP pension until we are 57, 58 thereabout. Okay, let's move on. Then another account you can open, this one is for adults, anybody who is 18 and above. There is no, so something I missed about the LISA. LISA, government will stop paying 25% into your LISA when you turn 50. Okay, when you turn 50, they won't give you 25% anymore. So quickly maximize it before you are 50, but you can keep paying into it until you are 60. But at 50, they stop giving you this 25%. Okay. So for stock ISAs, for those of us who are adult from age 18 and above, you can open ISA, which is the adult ISA, not junior ISA, an adult ISA. And mind you, when your child turns 18, their junior ISA becomes this adult ISA and is transferred to them automatically without your permission because they hold the account. Okay, so you can split your 20. So for this one, you have 20,000 allowance you can put into your ISA on a yearly basis. This is your own money, but when you can put up the 20,000 without you paying taxes on the profit. Now, if you have a LISA, as somebody who is above 18 but less than 40, you also have a normal ISA, you can only put in 20,000 into both of them. So 4,000 into your LISA, the remaining 16,000 into your ISA. Okay, that's the way it's divided. You can put 4,000 into your LISA, the remaining 16,000 into your ISA. So any money you make here is tax free. Disadvantage is that it's easy access. When it comes to LISA, you can withdraw from your LISA at any time. There are no restrictions, and you don't pay taxes on your LISA. And I like to tell people there are millions of people, thousands of people today who are ISA millionaires, and they don't pay taxes at all. And that's why government is trying to see what they can do about that, to take more money out, take a bit out of it. But let's see what will happen when they make the announcement before the end of this month. So you can withdraw anytime, you don't pay taxes on it. Yeah, there are more than 4,000 ISA millionaires who have been able to, and there are over, and this one is even a very old statistics, over 687 billion money in ISAs. But a lot of them are in cash ISA. So government is trying what they are trying to do is to say, don't put your ISA money into cash, put it into stocks, which is what we've been preaching for a very long time. For instance, I don't have a cash ISA. I only have 50 pounds in my cash ISA. I don't keep cash. So everything I do real estate and I do stocks. So these are the type of ISA you can open: cash ISA, stock and share ISA, innovative finance ISA, and a lifetime ISA. Okay, then the last one I'll be talking about today is your SIP. This is SIP for adult, a retirement account for adult, and this is different from your workplace pension. But if you are self-employed, you can open an account with pension with Nest Pension. Okay, more like your workplace pension. Your company, your limited company can open an account for you with Nest Pension. That is still like a workplace pension. It's managed for you, but you can parallel to your workplace pension, your NHS pension, whatever pension you have, you can open a SIP account. So which is self-investment personal pension. And any money you put into your SIP account, you can put a maximum of 60,000 into all your pension account, put your workplace pension and your SIP pension. You can't put more than 60,000 pounds in a particular tax year. Okay, and there's a lifetime limit to it. I think maybe like 1 million or so that you can put into pension all through your lifetime. Okay, and then see, government can pay you up to 40, they will give back to you up to 45% of what you pay you contribute into your pension. Okay, I will explain this to you. Let me use tax bracket to explain that to you. Government gives back to you any more a percentage of what you put into your pension. So that is a refund of your taxes that they're giving back to you. So UK tax band. So let me use this to explain it. So if you are a child or you are on benefit, or you earn between £1 to 50,000 and £200, £270, government will automatically give you 20% back into your SIP. Okay, for a child, for somebody on benefit, and somebody who earn below 50,270, you automatically get 20% credited to your SIP without you asking for it. Once you have a SIP, they give it to you automatically back into your SIP. Now, if you earn above 50,000, they will give you an additional 20% through your tax assessment. You get an additional 20% of anything you put into your personal pension. If you hand over 125,000, you get additional 25% through your self-assessment of the amount you put into your personal pension. I hope you understand. I hope that is well understood. So let's move on. Okay, so we get that much back. So government will give you your tax back, but they will later tax you when you retire when you retire at whatever age you start accessing the money. So like I said earlier, so the first 25% of whatever you put into you have in your pension is not taxable. Do I have that on this slide? So if let's assume you have £1 million in your pension account, the first 250,000 is not taxable. You can withdraw it and do whatever you want with it without having to pay taxes on it. But anything after that, and that you can access at the age of 55, now going to age 57 by 2028. You can access your pension until 57. I mean your SIP and your pension generally. Then anything you withdraw thereafter, you start paying taxes on it. So the first 25% is tax free. Okay, so that is SIP. What do we have next? Okay, these are the accounts you can open when you live in the UK. They are tax efficient. For SIP, you're giving your tax back. You will invest with your tax until you retire. Then you start paying the tax again. If you have ISA, you don't pay tax on ISA at all. Okay, and easy access, you can withdraw from it at any time. Have a junior SIP, the government gives you 20% for your children, and for those who are even out of work, and for elderly people, you can open SIP until you are age 75, I think. If you are still under 75, you can open your SIP account. Government give you some money until you are 75. Uh, then, then same thing with the adult SIP, they get taxed when you retire. And then you have the LISA, you don't get tax on LISA, you get 25% from government of whatever you put in until you're age 50. Okay, and then your first house with it, or it becomes your retirement account, and that is the sweetest of them. And then you have your junior ISA, it's also tax-free for our children. Okay, now opening your account is easy. That's my personal example. I think I've got about three SIP account now. I think I opened one not too long ago through the agency I'm working with, and I've got within the family, I've got about 5 ISAs, maybe like more than 5 ISA accounts, because you keep discovering a new platform that pays, that doesn't charge you so much. Then you move your ISA to another platform, or just have invest in another platform because their fees are cheaper. So I would give us the cheapest platform on which we can open this account. Okay, the best time to plant a tree was 20 years ago. Okay, if you say you missed that, then the second best time is now. The second best time to open and to start investing is now. So out of your income, I've divided our income into three different parts. Like if you remember in the area of financial control, you have you have a bulk of it, and in fact, maybe about 70% of it is for your food, your need, your wants, things you need to survive. You give out a percentage of it. As Christian, in terms of offering and tithes, charitable giving, and then you are meant to invest a part of your earning. Do not eat it all. Okay. And so this is an investment platform that I use, hl.co.uk. is the most expensive in the UK, but I have a lot of money there, and so I'm stuck with them, and I don't want to sell what I have there. But I've got this one cheaper, and then this one is free. This one is completely free, trading 212. So if you want to open but the only disadvantage is that they only have a ISA account. You want to open, if you're an adult, you want to open an ISA account, your best bet as it stands now is trading 212. Okay. If you want to open a SIP account and the ISA account, then you can do free trade. It's cheaper. If you live in Nigeria, these are the things you open. People do attend my training from Nigeria. These are the things you open. These are the new generation investment app. They can even allow you to buy stocks from America. You can invest in dollars on some of these apps. And these are the traditional fund managers in Nigeria: Stanbic IBTC, ARM Investment, AXA. I've used these three before. The three at the top. Then you have the First Bank, Quest, Asset Manager, and the rest of them if you live in Nigeria. And for those who live in United States of America, these are the popular ones. For those who live in America, in Canada, these are the popular ones. And those who live in the UK, majority of us probably are from the UK. These are the popular ones. They have their pros and their cons. I won't have enough time to explain all of them, but I've got where's the other one? I've got Interactive Investor, because I just have to open it through my agency, through my umbrella company. So I've got that. I've got Moneybox. Just to understand the way it works, I just put around 50 pounds into it. I've got HL, I've got Free Trade, I've got Trading 212. I've not tried the remaining one before. Vanguard is good for people who want to do just ETFs. And so AJ Bell is also good. This is the largest, followed by AJ Bell, and then we have the other ones. So if you want more question on this, please ask in the chat. And if you want to understand that more, you can also which one is best for your situation, you can let me know and I will explain that to you. Okay, further explanation on the platforms, what differentiates them. These are my short list. Trinity 1-2, no commission fee, no account fee, free dividend reinvestment. You pay for FX if you buy American shares. They allow fractional shares. Very sweet. Okay. Yeah, shoot. What's the question? Then you have free withdrawal. If you invest with free trade, you pay a fee of £12 on a monthly basis if you open both ISA and SIP. If you open SIP alone, you still pay £12. If you open ISA alone, you pay £6. If you open SIP alone, £6. If you open both of them, you still pay £12 on a monthly basis, which is still a lot cheaper than what you get from what you pay on these other platforms. Okay, good evening, please. Will this video be on YouTube? Yes, the video will be on YouTube later, and then you can listen to it again. It will be on YouTube later, and I would, I will give you the YouTube address. I can just do it now. So if you go to YouTube, just type IBWFG. IBWFG. So if you type that into the chart, you will see, so this is some of my videos. You will see this my video, this my video, this my video. And so you see some of the videos that are posted. And so you can, so for instance, this must have been, okay, so you see some of the videos are posted there. So do a search after, give me till midnight, I will upload it today. And then by midnight or tomorrow, you probably have it there. Okay. Now, we have a few minutes left. I might not be able to touch real estate today, but let's see. So why do you pick stocks? Yeah, I won't be able to go deeper into that than the fact that look around you, like we said, we picked some company randomly a while ago. You're welcome. You pick a company randomly a while ago. Now, I'm not saying Microsoft is a good company to buy. I'm not saying Apple is a bad company to buy or a good company to buy, or Netflix or whatever it is. There's a need for you to do your research, study the financials of the company, which is called fundamental analysis. This is something that I can teach if you come to the advanced class, so that when you pick a company, you look at it and you know within 5 minutes whether you should buy the company or you shouldn't buy the company. And then, but look around you. Like I've said, you can buy S&P 500 index tracker. okay, or a NASDAQ index tracker. Those ones you don't need research on them at all. But there's limit to which they can return to you. But if you want the real big return, then you need to do a bit more study, know what the experts are saying, have a conversation about it, buy a little bit, and then buy more as you have money on a monthly basis. For me, I have an amount that go into my account. For my wife, we have an amount that go into our investment account on a monthly basis. And they buy the position we already have. So we buy more of what we already have. Just buy more of what you already have. And then you continue from there. Okay, another asset class is savings. Like I said, it will give you 4% because inflation is there. It will keep going down as the cut interest rate, savings account interest will also keep going down. At the time, it was maybe 0 point something percent. Okay, and then but there are also ways for you. Some of your money can, if your contingency money, for instance, can be in the savings account, you can easily access. Or maybe it can be in your ISA account, cash ISA account can easily access it. You can go on this money supermarket to compare, different savings account. And then I put money into NSNI. NSNI doesn't pay you any interest. It's zero interest. You just have a chance of winning £1 million. And then your money is secure because you are borrowing government money. Anytime you need your money, you can withdraw your money back. It's not like playing lotto. You don't lose your money. You just save your money there, but they don't give you interest because you are borrowing government money. You don't have a chance. Every pound you put into it, have a chance of winning $1 million for you. Okay, let me just, what should I say about real estate now? Let me see how much, the number of slides I have left so that we can wrap this up tonight very quickly. Okay, so I just got a few slides on, 2 slides on real estate. So real estate is another way through which you can build wealth for generation. By God's grace, it's an area which I also have experience. Bought my first real estate in the UK in 2010. That's about almost 15 years ago. And then after then, by God's grace, we've done a lot more after the very first one. And then what are the advantages of real estate? Is the fact that you are leveraging. If you are buying stock, you buy stock using your money. You want to buy 1,000 worth of stock, you put down 1,000 and you buy. You want to buy 500, you want to buy £50 worth of stock, you put down £50 to buy. When it comes to real estate, you put down about 10 to 25%, and then bank is going to give you a loan to buy for the remaining one, which is what is called leverage. So you are using other people's money. You pay interest on it, of course, but you're using other people's money to be able to leverage and create wealth. Capital appreciation, because the value of real estate almost doubles every 10 years. If you look at a period of 50 years, it doubles almost every 10 years. And I can say I have an example of that in my portfolio. I have real estate that have doubled in value over the last 15 years. Okay, capital appreciation, rental income, cash flow is the name of the game. You get cash flow when you have rental properties. It might not be much because a lot is going into maybe repairs and into mortgage repayment, but you have a level of cash flow. And if you are not innovative and do what people are doing right now, the rent to rent and the rest of them, that is out there where you have people, Airbnb and the rest of it, people make a lot more in terms of cash flow when you do that. The equity release is when you're able to pull out money from a building, a property, and then you can buy another property. And any money you pull out is tax-free. You can use the way you want because it's more like you taking more loan actually. And then you can release equity from properties to buy more properties. And those are one of the advantages. There's also a physical asset that you can see, feel, and touch. And there's asset shortage, always an asset shortage in the UK and all over the world. So it means that if you have a very good house, somebody will be willing to rent it off you. It's diversification of portfolio. So you have real estate, you have commodities, you have stocks and shares, you have bonds, you have savings account. And then it's a store of value against inflation. So this was an example I was talking about. 2010, a 3-bed end of terrace, bought 70,000. I think the price is over 150 something thousand now. Just with a seed of 10,500, then which was 15% of the value of the house, a worth of more than $500,000 has been created because I've done equity release from this house to buy another house around London, and that house is worth about 380,000 right now. And so we're talking about a 10,000 seed producing almost 600,000 in value. And that is just from two properties with just a seed of 10,000. So you can imagine, and people think the price is going to fall. Well, it fell 2008, 2009, but it's double right now. So the earlier you get in, the better. New rules are coming in April. There'll be increase in stamp duty and a lot of other things coming in. But notwithstanding, all these costs will be passed on to tenants anyway. I think that's the sad part of the story. It's going to be passed on to tenants. Okay, so I put something here, don't wait until you can afford a mansion. So get on the property ladder as soon as you can. Some are waiting to buy a brand new house in a new development that will cost them 360,000 as their first house. There's something wrong in doing that. But if you want to have what is called delayed gratification, I'm living in the fourth house now. Okay, if I'm correct, one, two, three, maybe in the third house right now, and I'm not even yet. I'm not gotten like to my dream house yet. Okay, my first house I knew it wasn't my dream house. I knew I can't stay there more than 2 or 3 years. Okay, and it's 15 years. I still have the house. I lived there for just maybe just 2 years. I think we left just 2 years. Okay, I knew I wouldn't be there for more than 2 years, and see what that has produced for me. So get on it. It might not be the area you want, but get on it with what you have. Live there for 2 years, and then move on. Remortgage it, pull out a few money, save, join to it, then buy the next one at another 10%, and then you let that one out. Okay, and you can continue later. You need to register a company and continue with that. So get on it as soon as possible. Do not wait. So I will be stopping there. I won't go into entrepreneurship, but what I want to say is that to know more about this, even I've said a lot, but again, there's still a deeper level you can get to, that you need to understand a little bit more when it comes to stock investing. I do run the master class. You are welcome. The master class is £150, and I made it so cheap that it's one of the cheapest around. The master class, since you've asked, let me just go there. So masterclass, we go deeper into fundamental analysis. How do you analyze a company before you buy the share, so that you know what to add in your portfolio? So that you can, we analyze what ETFs are, what mutual funds are, individual stocks are. We formulate a strategy. We do practical sessions, and then you join a community of investors. I have a Discord channel where I have people who have gone through the masterclass, where I share things maybe once in 2 weeks or once in a month thereabout. I interact with people, and then put in my thoughts into that channel, and then you can leverage on other people's experience. Then you start building, and then I share my portfolio strategy with people who have gone through the master class, and a lot of other things that you're going to get. And then it's £150. The next one is 5th of April, first week in April is the next master class. So how does it go? It's a whole Saturday, 5 hours on a Saturday, from 10 a.m. till like 2, 3 p.m. We do a face-to-face instructor-led training on a Saturday. And thereafter, the following week, in the evenings, on Tuesday evening, on Thursday evening, like we're having right now, we do 2 hours of mentoring, of you building your portfolio, of you going through what you like put in my portfolio. We go through about a list of about 100 companies. You select like 15 out of the 100 companies. You do research on it. You are convinced about how good they are. Your portfolio is diversified across all the sectors of the economy. And then by the end of the second week or the third week, you have a ready-made portfolio for you that you can start investing in. So you can start putting in £50, £100, £1,000, £2,000, depending on how much you have to put in on the company that you have selected during the period of the training and the mentoring period. And so all of that you have for £150, and it's happening the 5th of April. Okay, and if you say, okay, I don't want to come to the class with everybody, I want a private tutoring, I want a private mentoring, then it's 495. That means I will do it. I will hold your class. If you're busy on Saturdays, it means you could find another time. You could say, okay, I'm going to spread my class over a period of 2 or 3 days. Okay, I'll do 2 hours for over 3 days to cover my own class. Then I can do that at your time with your family, and then your spouse, your children can come together. We can build a portfolio for you and for everybody, and that will be 495 for a one-to-one portfolio builder session. But if you for the general class where you have like 5, 10 people in the class or more, it's £150. Okay. Yes. Okay, I hope that answers the question. Then let's move up. So today, what have we done today so far? So we've talked about the fact that you can build wealth and become a millionaire in a generation without inheritance. We talked about the 7 pillars of building wealth. Talked about the 5 phases of building generational wealth. We talk about the fact that there's need for us to increase our capacity to earn more money so that we can put more money into investment. We talk about the power of compound interest in relation to the stock market, and then we look at different investment types and account that you can open. And then we talked about the fact that the need for us to be consistent in season and out of season, that season and out of season. And then you need continuous education, like we've talked about the master class today. So the next step that we need to take is create a budget based on the fact that there's a need for a strong financial control. You need to create a budget. Don't do it in your brain. Do it black and white on paper. Do it on a spreadsheet so that you know how much exactly is coming in, how much is going. And like I said, go watch my video, the one in January, giving purpose to your money. Go watch that, please. That will give us an understanding, simple on how to do budgeting. You see what I'm doing there. Don't forget to add yourself as part of your expense item. Very important. Pay yourself first. When you're doing your budgeting, you should be number one on the top. Maybe after giving your offering or whatever, you should be next on the line. Okay, create an action plan to become debt-free. If you are not already debt-free, set up a standing order to pay into an investment account. So open an investment account and pay into either a SIP or an ISA. If you don't have one already, then invest in your first fund or share. If it's an S&P 500 you're going to buy, you're not coming for the master class, if you're not coming, just go open an account, buy S&P 500 and see and just watch it grow. Okay, even now the market is down now for the past 3 weeks. Market has been down for about 3 weeks now. It has created an opportunity for you to buy at what the price was like 4 or 5 months ago. So you have an opportunity of buying at last year's price. Okay, so there's a big opportunity right now, and then register for further education, which is the master class, and reach out for me if you need any assistance. My phone number is on the website where you register from. You can drop me a text at any time. Okay, questions. If you are interested in the master class, just go 2 ways you can register, or you can either do it manually or you do it automatically. If you go to the website ibwfg.com, go to masterclass, click on that link that will allow you to check out using PayPal, and fill the form, and then with PayPal you are able to pay on Zoom, or you can pay into this account. Send me your name and your email address, and I will register you manually. So either of those 2 ways is how you can register, and then you can just read more about the masterclass on this page. Okay, I'm waiting for questions. I'm just waiting for questions to come in. If you have questions, please ask. Okay, before we call it a day today. Okay, I would give us maybe a minute more to type the question or unmute our mic and ask the question. Okay. So in the absence of question, we'll call it a day. Okay, I hope to see us in the master class. If not, you are welcome. Thank you very much. And then I do this on a monthly basis if you want, and I try to vary the topic. If you want to have another test next month, I think the date should be on the website already. Go on the book a seminar, and then the next one is going to be 3rd of April and 1st of May. Those are already there for us. They are all free trainings. Can come around and just renew your knowledge and just understand a little bit more what is going on. Okay, thank you very much for coming tonight. I appreciate you spending your evening with me, and do have a wonderful rest of your day, and hope to see you around. Thank you. Have a wonderful evening. Goodbye.